A few weeks ago, I did a video where I talk about the mistakes I made in the first year and a half to 2 years that I've been on during my journey as an amateur investor. Some of these mistakes were really valuable lessons, and some of them I learned the hard way. And if you haven't seen that video, the link should be appearing right about now, just up there, and you can watch that video and you can learn about the mistakes I made, how they impacted me, and what I've done to correct them. One of my viewers left a comment on that video talking about how mistakes can be a better teacher than the gains that you make and the positive things you do. And I somewhat agree with this. I think by making mistakes, you can find out what doesn't work, and it will point you more towards the direction of what is good, what is the right way to do things. But in my opinion, it's really important that you also recognize the good things that you've done and that you continue doing them as well. So in this video, I'm going to tell you about the good things that I've done and how they've worked out well for me on this investing journey that I'm on. So let's get right into the video. What's up guys, my name is Johnny. Welcome to Millennials with Money. I upload to YouTube every Wednesday and Sunday, giving you tips on how to take control of your finances today to create a bright financial future tomorrow. If you like what you see on the channel, I'd really appreciate your help in reaching out to more people. You can help me out by hitting the like button, subscribing and clicking the bell for notifications, and make sure you tell another millennial that this channel is where the good stuff goes down. The first thing I did right was that I prioritized investing the moment I had a stable income from my first job. Now this is a really funny one because I remember having a conversation with a friend and I was telling her about my new job. I remember saying to her, "This is great, I've now got some stability, I can start thinking about investing and saving and putting some money aside for the things I want." And she looked at me like I was crazy. She was like, "What? You're like 24, 25, you should be going traveling, spending money on what you want." And there's nothing to stop us spending money on what we want within reason. Me, I love to travel. I have spent some of that money that I've earned from my job on travel. But if you look in my budget, one of the first categories when money goes out are my allocations to my funds, to my investing accounts, and to my savings account, because I'm really big on building my financial future. I know that time is my friend, and I know that the earlier you get started, the more time you have, which means the more powerful the effect of compound interest can be on building your wealth. The second thing I think I did well was that before I started investing, I read up about it, I watched videos on YouTube, and I gathered all the information that I needed before I made my first transactions in the stock market. If you're watching this video and you want to get started investing, it's a really great thing. You've got a great mindset and you want to build your financial future. But let me tell you that investing is not as simple as just picking any company that you like, buying it at one price and hoping that it will go up to sell at a profit. There's a lot of things you need to understand. You need to understand how stocks behave, how the stock market works, the fact that it's different from the economy. You need to understand different types of investments. You need to have a strategy. You need to know how to diversify effectively your portfolio. Now, I've done loads of videos about several of these topics on my channel. I'll leave a couple of videos up here if you want to go check them out in more detail. But yeah, I really encourage you, gather that knowledge, not just from me, from other sources as well, whether it's online resources, other YouTubers, books. Go get that knowledge before you start investing. It will give you a lot more confidence and you'll be able to make much better decisions. And even though you will end up making some mistakes, they're not the kind of drastic mistakes that will put you off the stock market and investing forever. They're the kind of mistakes that will teach you lessons, like the lessons that I learned. Lessons that will make you more aware of how the stock market behaves, how to adjust your strategy accordingly, and how to keep making good financial decisions. Personally, I watched a lot of videos on YouTube. But if there's any students that are watching this video, your university e-library is your best friend. The number of resources that you have free access to thanks to your university is immense. I still had access thanks to my master's program, and I got a book called Dividend, Still Don't Lie, which essentially gave me the basis of my strategy today, which is dividend value investing. I really like this book and I definitely recommend it, but a simple finance and investing or stock market search in your university library should put you on the right track to find some useful resources. The third thing I did really well was that I started small with my investments and I gradually started building them up as my confidence and my understanding grew. Now, I didn't actually start investing with Trading 212 as I wasn't aware that it was available at the time. I started investing through a brokerage account with my bank in France, thanks to the tax advantages that it offered while I was living there. And I did pay commissions for the service, but they were acceptable to me as a newbie investor. That said, I didn't go crazy and throw thousands and thousands of euros at the stock market right from the get-go. I went little by little, putting in smaller quantities just to help me build up my confidence, to help me get used to making transactions on the platform, and to slowly build up that portfolio that I was trying to build. A lot of people talking about only putting in money you can afford to lose into the stock market. I agree, but I'm going to phrase it a little bit differently because I think this is a more accurate description. I think you should only put in money into the stock market that you can accept losing and that won't have an adverse impact on your current financial situation if you lost it. Obviously, nobody likes to lose money, and the goal in the stock market is of course never to lose money, but it is nevertheless a possibility, and it has a higher probability of happening with less experience that you have. So don't go head first in there. You can use a platform like Trading 212 that doesn't have commissions, and you can invest from as little as €1 into that stock market, and slowly but surely you'll build up your confidence. You'll see how the market works, you'll see how stocks do tend to go up over time, and you'll start to feel a bit more confident about taking those investing decisions. Fourth thing I did correctly was that I picked a good broker. So I picked a broker that had a fairly simple interface, that had low commissions and a good user experience. And while I was with them in France, I've had a really good experience with that broker. Since I've left, it has been anything but that, but that's a story for another day. Anyways, the point here is to pick the right broker and to make sure that you're using a trustworthy broker. Now, I've made a video on this which is available on the channel. Again, I'll leave that up here. I know there's a lot of plugs to other videos on this channel in this video, but I do think if you want to explore some of these themes in a lot more detail, then it's worth checking out these other videos, as they all link back to this video and come from my investing journey and the mistakes and good things that I've done. One thing that you need to be extremely careful of is not to choose a CFD broker, but to choose an investing broker. Be wary of platforms such as eToro and Plus 500 who have aggressive marketing campaigns trying to get you on the platform. But whereas you think you're investing in the stock market, you're actually investing into CFDs and margin trading. And without getting into too much detail, you don't actually own the stocks on those platforms. You're simply trading them, and you're trading them at a margin that's greater than the actual money you have, which is called leverage. The risk of working with leverage is that it is a lot easier and a lot quicker to lose money on those platforms. And I don't want you to lose money, but a lot of people do lose money through CFD trading. These websites even see it themselves. You'll see warning messages like, warning, 85% of investors lose money through CFD trading. But it's in the small print, and because you're a newbie investor, you don't know what that means. What you want is just a standard investment broker like Trading 212, like Dividend, like your bank, for example. And yes, they'll give you a warning, but the wording will be more along the lines of something like this, where they'll say investing could result in a partial or total loss of capital. They won't say that 85% of people lose money in the stock market, because that's CFD trading essentially. And by the way, this point that I've just mentioned now, I didn't say it in my how to choose a broker video. So if you're watching this video, you got a free extra bonus tip that's not included in that video. The fifth thing I did well, which was incredibly difficult, especially in March this year, was that I detached my emotions from my financial decision making. When the entire stock market crashed in March this year due to you know what, my portfolio took a massive hit, and it was really painful to see 30% less money in my account than I'd had in January, especially given how much I had invested. Really painful to the point where I almost felt a bit sick to my stomach to look at it sometimes, and I just wanted to keep it out of sight. Nevertheless, because I'd done my research, because I knew the facts about how the stock market generally behaves, I knew that I shouldn't sell at that point. I knew that I should just ride this out and hold on. And that's exactly what I did, as tough as it was. And you know what I also did? I bought more stocks at the bottom. I bought more while they were low, and now I've made significant gains on that. And the stocks that I had that were down in March, Well, some of them are still down, but my overall portfolio is back in the green, and that's the main thing. And it's testimony to the fact that you should definitely detach your emotions from your financial decision making and investment decisions. Because if I had decided to sell based on how I felt, would I still be investing in the stock market today? I don't know, and I would have lost 30% of the amount that I'd invested. If there's a key phrase that I want to give you that sums this up nicely, always remember this: go with what you know, not with what you feel. Point number 6 comes back to something I mentioned a little bit earlier, which was that I chose a dividend value investing strategy and I didn't choose growth stocks such as Amazon or Tesla. Now sure, stocks like Amazon and Tesla have been really generous to investors with a high appetite for risk and who are willing to take a shot on them. And the returns that I've made in comparison to the returns of investors in Amazon and Tesla, yeah, completely different, way below. But do I regret it? No. Amazon and Tesla are quite speculative stocks. They're growth stocks, which means there's a lot more uncertainty and a lot more risk around them. So although they have ended up producing high returns for investors, that could have easily gone the other way. Meanwhile, while I invest in established companies with good dividend track records, I can almost certainly say that in the future I will get paid dividends by that company that I can then reinvest to get more dividends. And slowly but surely, it's building a stream of passive income, which is something that a lot of us want to achieve in financial independence. And regarding the dividend history of those companies, you'll have seen from some of my other videos where I'm investing in trading 2 on 2 and picking my companies. I'm very strict on that dividend history. I want absolutely minimal to no interruptions over 20 years at least. That gives me the confidence that even in economic downturns, when things are good, if the company has problems, that they're still prioritizing their dividend and that me as an investor, I can still count on a payment coming in the future. And point number 7, again linked to my strategy. So the first part of that strategy obviously was dividend, but the second part was value. So I'm dividend value investing. What that means is I don't just buy a stock at any price. I look to buy it undervalued. When you understand the concept of value, you'll understand that sometimes the price that the stock is trading for on the market may be greater or lower than its fair value that it can be assessed at, or than its book value, for example. There's many ways to value a company, but the main point I'm making here is that you have to understand value if you want to give yourself a chance at making good capital gains. And personally, I don't think you should just buy a stock at any price. Once you've got the concept of value down and you understand why you should buy undervalued stocks, you'll see that you can make nice capital gains as well as dividends when the value of the stock increases. And you also minimize the risk that a fall in the share price could wipe out any gains you've made through dividends. So yeah, I'll typically buy shares when a company is undervalued and trading at a price lower than its fair value. The only exception I have with this is in my Euro stocks pie that is also on this channel if you want to check that out. And also when it comes to ETF investing. What I do here is dollar cost averaging. And the reason I do that is because of the recurring contributions feature in trading 2 on 2. And when it comes to ETFs, as they're tracking indexes, the index tends to go up over time. So it makes more sense to just keep paying in. Personally, I do prefer value investing and lump sum investing to dollar cost averaging. The only problem is that it requires a bit more understanding and a bit more time spent researching the companies that you want to invest in. So guys, what you'll have seen from these 2 videos that I've made is that you will make mistakes, but that's okay as long as you learn from them, and that you'll also do good things, and it's important that you recognize them as well. To get better as an investor, you need to look at both the good things and the bad things. You can't just look at only one or only the other. You need to have a balanced assessment of your own ability as an investor to be able to get better. So over to you guys. I'd love to hear from you about the good things you've done since you've started investing. And I'd really love to hear from you as well if this video has made you realize that you've actually done some good things. So why not leave a comment and let myself and the other viewers on this channel know what the good things are that you've done. That's all from today's video. I hope you enjoyed it. Be sure to check out the Millennials with Money social media and internet pages, and also the other videos on this channel. I'll see you on the next one, and let's get this money.